This is Japanese Economic Review Channel. This time, let's take a look at SBI Securities' domestic weekly outlook.
Yeah, and there is a lot to get through this time around.
There really is. I mean, we're doing a full deep dive today. Our mission is basically to break down this comprehensive SBI report and equip you with, absolutely everything you need to know for the week ahead.
Right, because it's going to be a very busy week.
Exactly. So we're splitting this deep dive into three distinct sections. First, we'll cover this week's stock market outlook. Second, the materials to watch and foreign exchange. And finally, we're going to walk you through a really detailed weekly timetable.
Which you're definitely going to need. I mean, we're catching the market at this really fascinating intersection right now.
Oh, completely.
You've got these record-breaking domestic stock highs, but they're happening right alongside highly tense Middle Eastern geopolitics. And then right on the horizon, we have a looming central bank week.
Yeah, it's a huge collision of factors. So let's jump right into section one, this week's stock market outlook.
Let's do it.
The headline stats here are just staggering. The Nikkei is sitting at 58,475.90. That's up over 1,551 points from the previous weekend.
It's massive.
And the TOPIX is at 3,760.81. I mean, the Nikkei actually surged over 1,000 points twice in a single week. It's aggressively pushing toward that unprecedented 60,000 mark. Okay, let's unpack this. Why is this happening?
Well, the market is basically already pricing in an end-of-war scenario between the U.S. and Iran.
Wait, even though the first peace talks just failed.
Yeah, exactly. I know it sounds counterintuitive, but the market is looking ahead, expecting a second round of talks. They're leaning heavily on this underlying belief that neither side actually wants prolonged warfare.
Right, but I mean, if the first talks failed, isn't the market kind of counting its chickens before they hatch?
Oh, absolutely.
Like jumping thousands of points on just the hope of a second meeting feels like walking a tightrope without a net.
It is a tightrope. The risk of both countries returning to a fully belligerent stance is very real. But what you have to understand is the underlying polarization in the market right now.
What do you mean by polarization?
So the index is basically being dragged up by this complete revival of AI-related stocks.
Ah, right, the tech boom.
Exactly. But underneath that surface-level optimism, there's a really harsh reality brewing for other sectors. It's like the market is a hot air balloon.
Okay, I like that analogy.
The AI stocks are the burner, right? Pumping heat into the balloon, pushing it up towards 60,000. But tied to the basket are these really heavy sandbags representing the physical economy.
And those sandbags are getting heavier, mostly because of the Strait of Hormuz, right?
Exactly. When Japanese companies release their March-end earnings later this month, we're going to see some severe business outlooks for the new fiscal year.
Because of the supply chain bottlenecks.
Right. The blockade of the Strait of Hormuz is causing massive raw material price hikes. Procurement is becoming a total nightmare.
So even if the AI software companies are doing great, the companies that actually manufacture physical goods are getting crushed by shipping costs.
Precisely.
Which gives us our forecast. SBI expects the Nikkei to range between 57,500 and 60,500. And while this week focuses heavily on those U.S.-Iran talks and Western tech earnings, next week is all about the BOJ and ECB potential rate hikes.
Right. The central banks are going to be the next big hurdle.
So the stock market is riding high on geopolitical hopes, but if we look at the currency market, that exact same geopolitics is creating an absolute roller coaster for the yen.
It really is.
Let's move to section 2, materials to watch and foreign exchange. The expected dollar-yen range is sitting between 157.40 and 162.00, and last week's swings were just wild.
Yeah, it was whiplash for anyone trading currency.
Totally. Monday saw the dollar bought and the yen sold off hard because of those failed U.S.-Iran talks and the oil spike. Then things kind of stabilized on Tuesday.
Until Thursday.
Right, Thursday. We had a sharp yen rise because Finance Minister Satsuki Katayama came out with a stern warning against a weak yen, but then it reversed all over again after BOJ Governor Kazuo Ueda's press conference at the G20.
What's fascinating here is the underlying tug-of-war happening with central bank expectations.
How so?
Well, Governor Ueda heavily hinted that the escalating tensions in the Middle East are hurting Japan's economy. And when he said that, the market instantly dialed back its expectations for a BOJ rate hike at their upcoming April 27th to 28th meeting.
Oh, because if the economy is hurting from high oil prices, they aren't going to want to choke it further by raising rates.
Exactly. And since higher rates usually support a currency, taking that hike off the table just pulls the rug out from under the yen.
But wait, let me ask you this. If they sign a peace deal this weekend or agree to that rumored 2-week ceasefire extension, Doesn't the yen just surge right back?
You would think so, but no. Here's the reality check. Even with a peace agreement, the Strait of Hormuz isn't going to magically untangle overnight.
Right, the ships are still backed up.
Exactly. Oil prices will remain high, which damages Japan's fiscal health because of how much energy they have to import. That creates structural yen selling pressure.
So the yen stays structurally weak.
Right. However, the constant fear of government currency intervention, the Ministry of Finance stepping in to buy yen, is keeping the dollar from breaking past its July 2024 psychological ceiling of 162.00.
They don't want to get caught holding the bag if the government intervenes.
Precisely. And on the bottom end, the floor remains the 13-week moving average around 157.4 euro. So we are stuck in that corridor.
Now that we know exactly what macro forces are pulling the strings, Middle East oil, central bank jitters, and AI stocks, let's look at exactly when these triggers might get pulled. Let's dive into our third segment, the weekly timetable.
And we have a lot of data hitting the wire this week.
Yeah, starting with Monday, it looks like a relatively quiet table setter. We get Japan's Tertiary Industry Activity Index for February and Tokyo condo sales for March, plus China's loan prime rate.
Yeah, Monday is mostly setting the baseline, but Tuesday is where things start to heat up regarding corporate health.
What are we looking at on Tuesday?
We've got U.S. retail sales and the German ZEW Economic Sentiment Index, plus massive U.S. healthcare and industrial earnings from GE and United Health.
Oh, wow. GE is a huge bellwether for the physical economy.
Exactly. And domestically in Japan, OBIC reports earnings, and we have the Baton's IPO.
Okay, then Wednesday, things really kick into high gear. Japan releases March trade statistics, but the real spotlight is on big tech and heavy industry earnings.
Absolutely. This is the big one.
We've got Boeing, IBM, Tesla, AT&T, and CME Group.
And remember how we talked about that AI revival holding up the Nikkei in Section 1? This is where that narrative gets tested.
You mean the hot air balloon burner?
Exactly.
Yeah.
Tesla and IBM's results are going to either validate that massive optimism or completely shatter it. If they show weakness, that 60,000 Nikkei ceiling might look very far away very quickly.
Which makes Thursday look kind of terrifying. I mean, Thursday is basically global PMI day.
Yes, it is.
We get manufacturing PMIs from Japan, the Eurozone, and the U.S., plus heavyweight earnings from Canon and Shimano here in Japan, and Intel and American Express in the U.S. Looking at Thursday, it feels like the ultimate stress test for the global consumer.
That's a great way to put it.
Like if PMIs show contraction while Intel gives weak guidance, could that be the needle that pops our 60,000 Nikkei balloon?
I think it very well could be. It just goes to show how fragile this optimism really is. If the forward guidance from a giant like Intel falters, the market might finally look down and notice those heavy sandbags we mentioned.
Right. And then we stagger into Friday.
Friday is a massive Japanese data dump.
What are we getting?
We're getting the March Consumer Price Index, the CPI, and the Corporate Services Price Index.
Okay.
Governor Ueda watches those extremely closely for inflation trends.
And there's a ton of earnings too, right?
A huge deluge of domestic earnings. Keyence, Fidukut, Nomura, Kikkoman, Hitachi Construction Machinery, and Chugai Pharma.
That is a packed Friday. But there's a wild card here that we need to mention. I saw this surprising detail in the SBI report.
Oh, right. The U.S. data delay?
Yeah, U.S. economic indicators might actually be delayed this week due to a potential U.S. government shutdown.
Which is a huge wrench in the gears.
How does the market react if that happens, if we just don't get the U.S. PMI or retail sales data?
Well, a sudden lack of hard data causes markets to trade entirely on rumors. It exponentially increases volatility.
Because nobody has the actual numbers to anchor their trades.
Exactly. Algorithms and institutional traders start reacting to whispers and unconfirmed reports.
Yeah.
It's a very dangerous environment when you're flying blind like that.
Wow. Okay, so just to quickly recap all of this for you, you are now primed to watch the Nikkei test that historic 60,000 mark, to monitor that tight 157 to 162 yen tug of war.
Right.
And you are ready to navigate a really perilous earnings calendar that is just completely complicated by geopolitical supply chain issues and potentially a U.S. data blackout. It's a lot to keep track of. And honestly, beyond this week's immediate trades, I think there's a bigger picture question we really need to ask ourselves.
What's that?
Well, we've talked so much about the Strait of Hormuz bottleneck, If this bottleneck forces a permanent rerouting of global energy supply chains, will Japan's reliance on imported energy establish a permanent ceiling on its economic growth?
Oh, wow. So regardless of what the BOJ does with interest rates.
Exactly. If the structural costs of energy stay this high permanently, traditional monetary policy might not be enough to fix it.
That is a fascinating and kind of sobering thought to leave on. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.